Bitcoin is not a natively productive asset. It's a great asset to hold. But if you want to create yield on Bitcoin, like Michael Saylor has done, you need to financialize your stock. Ethereum doesn't require that because Ethereum is a proof of stake chain where you can stake your Ether and you can earn a return of 2.5% to 3% native yield on your asset. The only people in the world who truly have permanent capital are the sovereign wealth funds. And what you see them do is take a longer term approach to use that competitive advantage to get economic benefits for their funds. In the case of us, we're not an ETF, we're not a hedge fund, we're not a VC fund who has to return money to investors when they want it.
Welcome back to another episode of High Stakes. I am your host, Alex Nowaka, and today I am joined by Joseph Shalom, the CEO of Sharplink. Welcome to the podcast, Joseph.
Great to see you, Alex. We always have great conversations, and I'm hoping today will be the best.
I think it will be. I'm confident in that. So, Joseph, you spent nearly 2 decades at BlackRock in a variety of different roles. I'm always curious for folks that have spent that much time in traditional finance, what their single sort of formative learning was as part of that experience. I'm curious what that was for you from your time at BlackRock.
Yeah, so I had an interesting career. I went to law school and I practiced law before joining BlackRock. And what's interesting is I think back in the old days, financial institutions hired people for jobs to be done. You're a portfolio manager, a trader, an operator, a compliance executive, an investment banker. I was actually interesting. I joined BlackRock not on the asset management side, but in their fintech division called Aladdin when it was a startup back in 2005. And it was actually shocking because I'd never done any of those core jobs that an asset manager does. And it forced me to become a horizontal leader, learn second best about 10 topics, and then help people solve problems and bridge gaps. I think to me, I never anticipated going into finance, certainly didn't anticipate going into crypto. But I think if there's one formative lesson, I'm going to give you 2. One is there is nothing you should do in your job that is not first focused on what the client demand or the product fit is. And I would say, opinionated, crypto is not great at first focusing on the client and the product fit. And then the second thing I learned after 20 years at BlackRock, and I'm really grateful, is that when I was at BlackRock, we were in the business of raising standards, not lowering standards. And that's not always the case when there's new technology and new opportunities. And sometimes you have to go slow first to speed up and win. And so those are the 2 things. Put the customer needs first. And then second, be in the standards raising business, not the standards lowering business.
The next thing I would ask you, Joseph, is you've gone from one of the largest asset managers on the planet to building an Ethereum Treasury company, and frankly, one of the largest ones in the industry. How did you underwrite the decision to make that transition? What were the things that you thought about? What were the things that you evaluated? And how did you go about evaluating that change?
Sure. So I'm going to give you the straight answer, which is I didn't go from BlackRock to Sharplink. I actually decided to retire and take 6 months to a year off. At some point, I want to teach in life. So I gave BlackRock plenty of notice that I was planning on retiring. And the rationale for leaving and the rationale for joining is we had built like a small and mighty team of digital asset professionals who genuinely wanted to change the world, and they wanted to leverage BlackRock's strengths as a fiduciary, its scale, its distribution. And we did amazing things, investing in some of the largest projects in the crypto space, launching the fastest growing ETF to 10 billion and 50 billion in history, a Bitcoin ETF, and then leading on tokenization. And at a certain point, my team wasn't young and inexperienced. My team was still young, but very experienced. They didn't need my 25 years of guided experience on how to navigate the ecosystem. So I decided to retire. I was out of the game for 6 weeks. Remember, I said 6 months, and got a phone call from friends affiliated with Consensus. And Joe Lubin was starting a digital asset treasury and was looking for a leader who can help guide a digital asset treasury, but in the most institutional way, kind of borrowing the best of what Michael Saylor has done in building a Bitcoin treasury, but doing it in the Ethereum ecosystem, which has some competitive advantages and differences I'd love to talk about. And then the final thing is I never in my life had ever anticipated being the CEO of everything. I thought of myself as like a great number two, but the idea of joining a company, hiring a team, pivoting a strategy, and learning how to grow into being a number one, but take all the lessons I had learned from 20 years at BlackRock into the new role. And I'm loving it, despite the fact that we're in a crypto consolidation period. I'm really proud of the team. And you know what? If you have the right principles and ideals, it doesn't matter if your price of ETH is 4,000 or 2,000. You're going to do good things and stick to your principles. So it was not a decision to leave BlackRock to join crypto. It was a decision to leave retirement and join a public company.
And you probably have one of the best vantage points on where the institutional sort of mindset is around digital assets. And I always use the analogy of a 9-inning baseball game. Where are we in that 9-inning baseball game as it relates to institutional adoption of the digital asset class? And I'm curious how folks should think about that and what the key things you look at to gauge that and that progress.
Sure. I'll give you my mental model, but I'll do it in a very linear way. I think when you think about the digital assets industry, I think there are four main primitives or building blocks that I want to comment on. The first is stablecoins. The second is crypto. And by that, I mean the high quality crypto projects and assets. The third is tokenization of real world assets. And the fourth is agentic. And I'll go through a rapid fire view. I believe stablecoins are in the third to fourth inning. And for your non-US viewers, like the first third of the match, it is maturing. There's more competition coming. It is the first proof point in history that a tokenized asset, in this case, a dollar, has utility and can be used in the real world. There's 320 billion of stablecoins, trillions of dollars of money movement of those stablecoins. But I think we're kind of in the first third. It's starting to mature and you're seeing an ecosystem form, especially outside the US, because 99.75% of all stablecoins are dollar denominated. Now you're seeing Euro, Hong Kong, Singapore, Japan, and soon to be Korea. I think so that's the money layer of digital assets. The second is in tokenization of real world assets, funds, stocks, and bonds. That I would say is in the bottom of the first inning. And I think that'll be a surprise to a lot of people because the first tokenization of funds started in 2017. Why are we 8-9 years later and still only in the bottom of the second inning is because we didn't have the regulatory clarity and we didn't have the institutional impetus. It's a $31 billion market of tokenized assets where the potential TAM is 400 trillion. Stocks, bonds, funds, real estate, private equity. And you're starting to see real momentum here. And my prediction is going to be bold. We're going to go from tens of billions to hundreds of billions to trillions of dollars of tokenized assets. I think it'll be funds. I think it started on the Treasury side, but you're going to start seeing most equities, and there's about 160 billion of equities in the US and European markets tokenized. So I think tokenization, bottom of the first inning, and it has the fastest growth potential. The third is decentralized finance. In decentralized finance, it's early, it's the transaction layer. That is a merger of stablecoins plus tokenized assets to allow it to execute. I think that is still maturing, maybe in the third inning. It's unclear to me if that execution layer is all going to happen in DeFi or is going to happen on centralized exchanges or the like. And the fourth is agentic finance, which is the wild card. We are in the top of the first inning of agentic finance, where you now have these primitives. You have tokenized dollar and stablecoins. You have the asset class exposure, which is tokenized assets, real world and crypto. You have an execution layer that's DeFi, and you take this and you put it on blockchain rails. And I think we're going to see agentic finance agents working on our behalf to move money, to invest, to pay people, to order things, and then agent to agent commerce, where you're going to have a marketplace where agents are paying one another for data, paying one another for services. moving assets between one another. That's a top of the first inning, and it could be potentially the definition of Web3. And I'd love to embellish on that, but I think that we're on the beginning of what could be the final war over the movement of money, and that's what Web3 is going to be, and who are going to be the winners and losers. So I think this is a multi-dimensional capability, but I think stablecoins, tokenized assets, DeFi, and Agentic are just the building blocks of what's going to be an agentic machine-to-machine intelligence economy.
And now maybe bringing this like closer to home for you, sitting as CEO of Sharplink, can you articulate for our audience the role you view that a digital asset company plays in sort of the broader digital asset ecosystem? You mentioned MicroStrategy. That's probably what most lay people are familiar with when they think about a digital asset treasury company. So maybe even putting it in sort of that context, but very curious how you see the role of a digital asset treasury company in the broader digital asset ecosystem.
So let me start with the purpose. Whether it is Bitcoin, ETH, or Solana, you have a lot of investors, both retail and institutional, who want exposure to that opportunity, sometimes on a short-term basis, sometimes midterm. Some of these people are buy and hold. And each one of these tokens has a thesis, like digital gold for Bitcoin, a store of value. ETH is going to be the settlement layer for most of financial activities, et cetera. And they have three different ways they can get this exposure. In the old days, they could try to buy spot Bitcoin or ETH, but most companies today, most individuals don't want to custody it, don't want to deal with wallet infrastructure. So if you want that exposure, instead of having to do all this stuff yourself, you could just buy a public equity, MicroStrategy if it's for Bitcoin, Sharplink if it's for Ethereum, and you get access to that token in a very simple click. You can buy or sell it whenever you want. The third way is to get it through an ETF. And when I was at BlackRock, not my team, but BlackRock launched the largest Bitcoin and Ethereum ETFs in history as an exposure vehicle. So that's number one. I think the difference between Bitcoin and ETH and MicroStrategy and ourselves is that Bitcoin is not a natively productive asset. It's a great asset to hold. I believe in it. I think everyone should have some Bitcoin in their portfolio as a hedge against, hyperinflation and debasement, and it's a scarce asset. But if you want to create yield on Bitcoin, like Michael Saylor has done, you need to financialize your stock. First, by issuing converts and taking on debt. Second, by issuing preferred stock with kind of double-digit coupon yields in order to create some leverage and some outperformance. Ethereum doesn't require that because Ethereum is a proof of stake chain where you can stake your Ether and you can earn a return of 2.5% to 3% native yield on your asset. So to date, we've been making our ETH extremely productive. We've accumulated billions of dollars of ETH. We have been staking it, earning the rate. And there are other ways to make it productive. You can put it in DeFi. You can put it in investment funds. So I think that is why you need a digital asset treasury is if an individual doesn't want to own spot Ethereum, ETH, they want somebody to make it productive, to custody it, and to have professional management. We could do it without a management fee. ETFs are great, but ETFs are constrained in terms of how much of their ETH they can stake because they need to provide daily liquidity to their investors. And then if you have permanent capital like a digital asset treasury, you can make it productive in long-term deals and get better returns from your investors. So the purpose of a digital asset treasury is in the Ethereum space to give an investor, an institution or retail investor, linear beta exposure to this ETH and Ethereum opportunity while making it productive for them and generate yield from your asset.
And how do you see the digital asset treasury space evolving, Joseph? Because I think that, we've seen a lot of digital asset treasuries launched. I think there's always a, sort of a dynamic that is what separates good from great, and great is what wins ultimately. So in that context, how do you see the space evolving? And what do you think the key attributes of good to great that make for an exceptional digital asset treasury company?
So first, I want to start by tipping our hats to Michael Saylor. Michael was the pioneer of this idea of creating a public company that would raise assets, take that money and buy a token, in his case, Bitcoin. I think you've seen dozens and dozens and dozens of Bitcoin treasuries. most of whom do not have the scale or the financial expertise to do what Michael Saylor is doing, which is start by owning linear exposure to Bitcoin and then start financializing your stock. He's in a bit of a pickle because he has outstanding debt. He's got outstanding preferred stock and instruments, and he has to pay it back. And so he's in that moment of deciding, do I raise more capital? Do I buy? Or do I need to leave a lot of capital on the sides or sell my Bitcoin in order to pay my debtors or pay my preferred equity investors? Ethereum saw fewer digital asset treasuries launched last summer. I think there were 6 or 7 of us who launched almost simultaneously with largely the same initial strategy: raise capital, buy ETH. We made it productive first. But at this point, I think there's only 2 or 3 of us who've been able to reach a multi-billion-dollar scale and exit velocity. And many of the smaller digital asset treasuries have essentially publicly capitulated, started selling their tokens, and have pivoted their strategy to do other things. So there's a couple of us in the Ethereum space. In the Solana world, I think there are 5 or so. Most of them really good intentioned. I don't think any of them have reached the scale of what you see in the Bitcoin and the ETH space. So I do think we're going to continue to see consolidation. What I think is required is scale, institutional management, and then, like I started, alignment of interest with your investors. And we've raised capital, billions of dollars of capital, but the way we've raised it has always been accretive to investors. And so I'd love to elaborate on that, but we put our investors first. But we recognize it's a highly volatile asset, and we've been in a roller coaster on the price of the asset and therefore the price of our stock.
When you think about Ethereum specifically, I think there's this bigger vision that most folks hold that Ethereum really has the capacity to really remake financial services infrastructure. And when you hear that sort of hope really for that technology and for that asset, what would you identify from your time in traditional financial services where you would say that infrastructure in traditional financial services has never really been able to cross a chasm that Ethereum actually can cross on behalf of its either users and or the institutions that utilize it?
First of all, I had a front row seat being at BlackRock, and more importantly, being in their Aladdin fintech business, where we offered a SaaS offering to most of the buy side, trillions of dollars of assets under risk management and trading capabilities and portfolio management. And you saw the beauty of American capital markets on the one hand be like 60+% of the world's capital markets, very efficient, a lot of liquidity. But the other side of it is it's some of the least efficient workflows and market structure that you can ever imagine. What do I mean by that? For your listeners who might be more crypto oriented, you want to buy a stock or buy a mutual fund. In the US, you wait a day to move your money and receive your stock. So the trade date plus one more day is when things settle. In Asia, it's 2 or 3 days. So imagine in your consumer life wanting to move money to one another or wanting to send a gift to somebody, and you can't do it instantly. You have to wait a day or 2 or 3. And the reason why that's not great, because the financial services markets do work, is it creates massive risks and inefficiency in the market. You have to hope your counterparty is going to be there tomorrow or 2 days from now to deliver. Your capital is tied up overnight. You have financing costs. You have counterparty risk. You have settlement risk. And it doesn't sound terrible in the day-to-day. It seems to work, but it feels like every 10 years, there's a financial crisis or a failure in the ecosystem, and it doesn't work. And your counterparty is not there, and people lose money. So what is exciting about blockchain technology, and Ethereum in particular, is you can have an asset, the same stock, bond, or fund, in a tokenized format that can exist on blockchain where you can trade it and settle it in an instant. And if you don't like the word atomic settlement, which is it can literally settle in an instant, how about just saying within minutes, hours, or the same day? You no longer have the counterparty risk that they're not going to be there the next day. You don't have to deal with overnight financing. You don't have to net lots of exposures against one another. So that's the instant settlement, which means you can start trading it 24/7. And some people would ask, like, the markets work. Why do I need to trade Tesla or oil 24/7? Well, at moments when you have an exogenous event like a war declared on a Friday night between the US and Iran, if you had crypto assets, you can sell out of it in an instant. If you had FX, you can sell out of it in a minute. Gold and precious metals. But if you want to express your view that you want to be long oil or short manufacturing that day, you have to wait till Monday and you've already lost. So the idea that the New York Stock Exchange and NASDAQ and crypto exchanges are now going to allow you to trade tokenized stocks, bonds, and funds 24/7, it's not going to be initially very liquid, but it will be over time, is a competitive advantage. And then the final thing is if you own an asset in a tokenized format, it's what we call composable. You can take this asset and borrow and lend it in much easier, transparent, and programmable ways than you can with a traditional asset. And that you could do that in traditional finance. If you're a big institution, you can borrow and lend your Tesla stock or your funds. Retail is going to be able to do it programmatically and earn additional return by just holding and lending and borrowing traditional assets. So it's a much better mousetrap. And Ethereum has the programmability, the smart contracts, the decentralization, the financial security that you don't see on many other chains. And it's got, I think later this month, 11 years of history of never going down with the most liquidity. And I know that sounds like I'm pitching Ethereum. I'm pitching new financial rails that are better for institutional investors, retail investors, and the means in which it's going to happen is largely going to be in the Ethereum ecosystem, along with a couple of other competitors who will all have roles in space to perform.
And that's a great segue into, tying something we talked about earlier in the conversation around stablecoins and tokenization and frankly, on-chain settlement. I very much believe, and the data tends to bore this out, that that's very much an Ethereum story today in terms of where the dollars are, the volumes. Obviously, Ethereum exists in a market that has competitors in the way of Solana and others. I'd be curious how you see Ethereum relative to the competitive space. And I think of this more as like the competitive space for institutional block space, right? How would you articulate the way that you view the competitive landscape and how the various components that you discussed earlier in stablecoins, agentic, tokenization, how those play into Ethereum story?
I'll be very direct, and if it's okay with you, opinionated. I believe there's truly only two fully decentralized cryptographic networks with economic security today that are like beyond reproach. That's Bitcoin and that's Ethereum. I think there are great competitive chains who've launched later, who've actually done a great job optimizing to throughput, to speed of transactions, and actually that's been their competitive advantage. Ethereum has been slow, but slow is sometimes intentional, meaning it's focused first on economic security and finality, the idea that a transaction will settle with finality, with real economic security. It's pivoted to a proof of stake framework where you have over 1 million validators, and the firm you work for is a leader in this space doing validation for people who own ETH to allow them to generate yield. But validation and of staked ETH also secures the network. So I think Ethereum is totally prioritized slow and secure and decentralized and diverse. It's never gone down. It's got, I think, 6 or 7 software clients to allow pure diversity. But I think what it hasn't focused on, and I think it's been intentional and sometimes unintentional, is this idea of having a sales voice, a way to talk to institutional. The Ethereum Foundation has done a remarkable job evolving and building the capabilities, but they never saw it as their scope to then say to finance and capital markets, hey, let me help you onboard to Ethereum. They've been more focused on the core protocols. And I would say in the last 2 to 3 years, some have viewed that as malaise. Some have viewed that as, not being focused. I just think the Ethereum Foundation was focused on the core protocol and they didn't view it as their role to be the business development arm of Ethereum. And it reached a bit of a tipping point. There was a lot of frustration in the Ethereum ecosystem, despite the fact that it had 1 million developers who've contributed, 1 million validators, the most economic security. And I think what you ended up seeing is the Ethereum Foundation decide to be smaller, focused on a core mandate. And that meant groups of really talented people in the Ethereum Foundation needed a new home to build and accelerate the protocol, to go to market for Ethereum. And there was a feeling of loss of narrative or loss of malaise in the messaging. So what you saw is groups of very senior talent spin out of the Ethereum Foundation, and a group of us who are not controllers and we're not control freaks. We're stewards in the industry. So Joe Lubin from Consensus in his personal capacity, Tom Lee at Bitmine as the largest Ethereum corporate holder, Sharplink as the second largest public holder of Ethereum, recognized that we needed to provide homes for these type of people and talent. And we announced 2 weeks ago the launch and the funding, not the control, of ETH Labs, a high density lab team of developers spinning out of the Ethereum Foundation who are going to be focused on building the next generation of protocol capabilities, shipping code for institutions, with also a focus on ETH beyond just a focus on Ethereum. And then last week, we announced Ethereum Institutional, a spinoff of the Ethereum Foundation's go-to-market team, who are there to be the front door, to be the marketing arm, the education arm, the go-to-market arm of Ethereum, which was sorely lacking. And again, these are nodes in what's going to become a little bit more decentralized. And I think some of the other layer one blockchains have done an amazing job at marketing, an amazing job at BD, but I think they've prioritized that potentially over network security and protocol. So I think Ethereum is at a moment of going from defense to offense. That's a long-winded answer, but very direct, very honest, and very opinionated.
And I think a follow-up to that is naturally, as those new sort of organizations that are responsible for really stewarding Ethereum into the institutional realm, what is your sense of what the current either friction is with institutions getting comfortable, and or maybe a misunderstanding maybe that those institutions have about the technology and the asset?
Yeah. So I always start with this idea of if you're watching an event, a game, a match, or a multi-decade trend, look at the scoreboard. And for the things that matter in terms of high quality transactions, stablecoins, tokenization of real world assets, and decentralized finance or DeFi activity, put aside Agentic, we'll get to that. By a mile, Ethereum is leading in each of those categories. I think over 55% of all stablecoin is secured on the Ethereum ecosystem, layer one and layer twos. I think it's around 55 to 60% of tokenized assets. I think that market share could grow. And then in the DeFi community, it was built on Ethereum. So if you look at the high quality DeFi transactions, borrowing, lending, swapping, it's largely an Ethereum story on places like Aave and Morpho. I feel very, very strongly that institutions care about 3 or 4 things consistently. And it doesn't matter if it's BlackRock or the Bank of New York or a pension fund. When they're talking about trillions of dollars of assets, where if you get something wrong and it's lost, people don't retire in dignity. They care about trust, security, and liquidity. And Ethereum is leading in all 3. So I think institutions have been choosing Ethereum. The likes of BlackRock, JP Morgan, Franklin Templeton, just last week, Robinhood, European governments. And so I think we need to not play defense. The inclination is to build on Ethereum. The markets are telling us they're choosing Ethereum for these characteristics. We just need to do a better job with the narrative and stewardship. The stake is there. We need a little bit more of the sizzle.
From my vantage point, you all are taking such a different approach at Sharplink relative to other folks in your market, and a lot of this comes down to how you think about productive Ethereum and finding the opportunities to really make it productive in unique ways. You hinted at some of the ways in which you do that at a very high level. I'm curious to just sort of give you the floor to maybe talk a little bit about what things you're doing there specifically that you think are most differentiated and why you think that. And again, I think that there's all sorts of ways you can take this in terms of what are things that are underappreciated, things that are overestimated in terms of like what can be done in the context of a digital asset treasury. So I'll give you the floor to maybe go into more detail of what you think you're most excited about relative to your thesis.
Sure. So if you're a digital asset treasury, a company who is the steward of the king's gold, what do I mean by that? Like, you're responsible for maintaining the security and productivity of billions of dollars. In our case, at this point, it's a little over $1.5 billion of Ether. It's our reserve token. You have a couple of obligations. One is to protect it, and the second is to make it productive, because ETH is a natively productive asset. So on the protection side, we've built a very institutional team. We work with the likes of Coinbase. We work with the likes of Anchorage Digital. Our assets are within regulated custodians. We have KPMG as an auditor. And most people, wouldn't say that's an amazing thing. I think it's an amazing thing. And when you have controls and you have segregation of duties and you're able to protect your assets at an institutional level, there is 3 words for that: respect for investors. And then the second thing is how we make it productive. We were the first Ethereum digital asset treasury to launch. We were the first to fully stake our ETH. And we do it through our custodians. We work with incredibly high quality validators and staking providers, including the company that you work for, who meet those very high bars of institutional standards. That is step one. And if you just want to stop there, you can. You can earn the staking yield. You can take that yield that comes in ETH and you can put it back in your portfolio and compound it. But we think we have a competitive advantage as a treasury company, as a public treasury company, that we have something that's called permanent capital. The only people in the world who truly have permanent capital are the sovereign wealth funds. And what you see them do is take a longer term approach to use that competitive advantage to get economic benefits for their funds. In the case of us, we're not an ETF. We're not a hedge fund. We're not a VC fund who has to return money to investors when they want it. We give people an ability to buy or sell our stock, but we still have our treasury, which means you can go steps along the efficient frontier to build a portfolio of yield. We started with staking. We participate in liquid staking tokens. We did a deal in the decentralized finance space earlier this year where we took about $200 million of our ETH and we put it in a liquid restaking token, and we kept it within our qualified custodian. We announced in June an intent to launch a $125 million yield and on-chain fund with Galaxy Digital. So Sharplink, public company on NASDAQ, Galaxy, public company on NASDAQ with high standards, where we would contribute 100 million of our ETH, they would contribute 25 million, and we would find these protocols who needed that startup capital. And in return for that, we would get some outsized yield. Again, we're not a VC firm. We don't want our productivity to be convex. We want singles and doubles. And then we're building a portfolio of this efficient frontier to use our competitive advantage. And I think others are doing a good job as well. We just happen to be focused on doing it with an institutional standard. And the result of that is we're the most institutionally held, as a percentage of our stock, Ethereum digital asset treasury. I think we're second to Strategy at about 48% of our stock is held by the world's largest financial institutions. So that is our thesis, and we do it in good markets and bad.
And then I was going to switch gears to, we talked a little bit about Agentic at the very beginning. I agree with you that that is a theme that did not exist 2 years ago. But if you look at the biggest names and the most influential companies and people in the industry right now, it is probably the most talked about, maybe tailwind, maybe opening vector within the space. I think we've always talked about AI in the context of it is an accelerant technology when put alongside a blockchain, but maybe like going specifically into AI and Agentic, like what has you most excited about the potential there? And frankly, just a very like maybe candid handicapping of like how real that's going to be and how soon. I'm a bit skeptical in terms of how soon, but I also see the prospect. And so want to get your take on that, Joseph.
So I'm going to be opinionated here, and this is not going to be a crypto-oriented answer. So the idea of agentic finance, which are initially agents working on behalf of individuals to move money, to invest money, to pay other people, is going to go from an agent working for us to really a world where agents are going to be working with agents on behalf. You'll start seeing agentic marketplaces where autonomously they're going to be doing your work, fulfilling your intent within the risk framework that you're willing to give them. But I don't think it starts as a crypto story. I'm going to be controversial. I think this is going to be the last war for control of money. And if you think of Web 1 as being uniting all the data in the world, and it created a lot of value, but it concentrated that data in a handful of people. If you think of Web 2 having pulled the entire population of the world into interconnectivity, your social graph, but it fell into the hands of a handful of people. And by the way, they don't charge you for this, but the business model is your data, your pictures, and your metadata. I think we're in a race right now that has started that people are not talking about, which is there's a race to own the rails of agentic finance. And I think you have 2 or 3 broad outcomes here, but I think it may be the last war over control of money. You have the likes of Visa and MasterCard and Stripe and Circle and Coinbase who really want to build those rails to support agentic finance. And therefore, they'll be the intermediary, no different than the people who built the railroads controlled the flow of data and the flow of goods. That is one outcome. And you might see 1, 2, 3, 4, 5 winners who are essentially going to intermediate every financial transaction, not only of you as an individual, but your agents doing that and your agents dealing with agents. And in return for that, they might make it very easy. They might make it very efficient. They might even make it free, except for the fact that they're going to see your transactions. They're going to recommend products to you. There may at some point, this may become fee liable. There is an alternative to that, which is unlike Web 1 and 2, which fell in the hands of an oligopoly, these big tech companies that did amazing work to step function human progress, but at the same time, they concentrated the ownership of these rails. There's an opportunity to not fall into that same outcome and truly have finance and agentic finance and agents working on your behalf within guardrails happen on a decentralized blockchain network. You have all the primitives that you need for agents. You have a chain that's fast. You have a chain that's instant settlement. You have micro payments of stablecoins. You're going to have tokenized assets that can be the asset layer. You're going to have execution capabilities in DeFi. It's going to be able to book travel for you within certain guidelines, pay for it without you even knowing about it. And there is an outcome where this is the first time trusted, fully decentralized rails can own a huge part of human activity. And so the data is not concentrated in a few people's hands. Your social graph isn't concentrated in a few people's hands. And where 2 things matter most, identity can be confirmed on chain. And even though AI and agents can start hallucinating, it won't be a black box. Every transaction will be auditable. And so there is this opportunity for a platform like Ethereum, something fully decentralized that gives you the guardrails to help provide the future rails for the movement of value and money, and it not be in chokeholds or on a couple of companies' railroads. And that war has begun. The battle and the race has started, and we'll see how we end up. But I think this could be the race for the rails of value. And I know that sounds really opinionated, and I'm not saying big tech is bad. They do remarkable things, but we have an opportunity to break that repeated pattern of outcomes.
So we'll need to park it there. Joseph Shalom, CEO of Sharplink. Thanks for coming on, Joseph. We look forward to having you on again soon.
Great to see you, Alex, and safe travels.
Absolutely.
That's a wrap on High Stakes, the podcast where Web3 meets the real world. For more insight into how blockchain and AI are reshaping institutions, head to validationcloud.io and follow @validationcloud across all socials. Stay tuned for more conversations from the front lines of innovation. I'm Alex Nowaka. See you next time.